what we're planning here is this is all about you. It's about your education. It's about you asking questions. So we've got a platform where you can go onto the website, and we're also sending out emails to everybody to say, if you've got questions about commercial real estate, this is your opportunity to get educated. This is your opportunity to ask those questions. Come directly to me. Ask me those questions. I love them. Okay, this is what drives me. So I'd love to be able to help you and give you those answers with regards, what you're looking for and what your questions are. So we sent out about a week or two ago to you guys, the audience, and we've had a couple of questions come back in, and I thought I'd just discuss those questions live on this platform. And if you've got any queries or you want to ask further about what I'm going to discuss, and I'm pointing at my PC over here because I've got all the questions in front of me. So let's dive right in. And I'm going to start off with a couple of the questions that have come through. And it might be a little bit of a repeat. So if this has already been posted, I'm going to go through the questions that came through during the week. Some of them I have done, some of them I haven't done. Some of them we've sent a video out. But the ones that I haven't done, we'll get to afterwards. So let's dive straight in. So I had a question from Chris. Thank you for your question, Chris. He's saying to me that he's got 300K of super. Is that enough to buy commercial property? Well, hell yes, Chris. Absolutely it is. Look, 300K is not going to give you a huge budget. It's probably going to get you maximum of around about 600,000. So it will be a reasonably small-ish type property. The problem with super at the moment is that the first-tier lenders have pulled out of super, which means that you can only be buying property in super right now from second-tier lenders. What does that mean? Long and the short, it means that second-tier lenders are lending at round about high 7s, so 7.8%, right up into about 8.1, 8.2%. What does that mean for you as a property investor? Well, if you're purchasing a property, either you've got to buy a property that is regional, which would be the higher risk, higher yield, so that you can cover that higher yield of roundabout, or interest rate of roundabout 8.1, 8.3%. That would be one option. The other option would be that you purchase a property, but it's going to be negative at first. So you might have to dip into it just until it sort of finds its feet. So what we always say is the first year that you purchase a property, it's generally your most expensive year. And then when you get to the second and the third year, it starts balancing out. So it really is something that we need to work together with. It's something that if you'd like to go through this and you'd like to have a look at the numbers, I can drill down on the numbers for you and I can help you out with something like that. So Chris, if you'd like to explore a little bit further, feel free, reach out and I'll help you out with pleasure. The second question came in, which is from Madhu. Madhu has asked a question, how to start up in commercial investment and find a place and price and negotiation. Well, Madhu, there's a couple of questions over there. So how to start up in commercial. We take you through a series of steps. And the first thing is to make sure that you are market ready. We call it market ready. And what that is basically is just to check what your budget is. So in other words, your lending criteria. So I'll send you some paperwork. It's just 2 pages, short little questionnaire. You send that back to us. We have a look at what your budget is. And if we feel that you would be prepared, that you are ready to go into commercial property, then we move forward. That's the one thing. The other thing is to get your entities and all of that sort of thing sorted out, to decide under which entity you're going to be purchasing. And then we have a discussion about budget versus price, so the price of the property that you can purchase at, and places, so areas that would be suitable for the budget, the yield versus your interest rate, and the type of property. So is it a industrial? Is it a retail? Is it street level commercial? office sort of thing, and then exit strategies and that sort of stuff. So very happy to help you out with that. Again, reach out to us, go to revolvecommercial.com.au, click on the links, book a call, and I'd be happy to help you out with that. I hope that is answering your questions. The next question that we have here is from Pradeep. And Pradeep has asked a question. He's got 4 residential properties, 1.85 in his portfolio, with a loan of about 1.5 mil. The capital growth of these properties, interest and principal, he's got an average year-on-year growth of about 10%, which is pretty good. He wants to get into a commercial property around about 2.5 mil, over 6% net yield, with a minimal loan, of course, and he wants to replace his wife's salary, which is 190K. So he's looking at something with an average growth of about 7.5%, and he wants something that's going to be around for about 7 to 10 years. Now, he's asking what sort of deposit is he going to need, what is the commercial property, what sort of property at around about 2.5 million. So, Pradeep, a lot of questions in there. Firstly, 2.5 mil, you're going to need minimum about 800,000 equity in order to reach that 2.5 mil. Types of assets, we'd have to discuss that. And this question, you definitely would qualify to buy a commercial property. It's a matter of how, and what type of assets. So again, my answer would be yes, for sure. You can buy a commercial property. You'd be set and ready for that. We'd have to have a look at what your loans are, what your interest rates are, what type of property, and where would be the best sort of, whether it would be metro, because bearing in mind that metro properties in that, and depending on which metros, could be anything in, if you're looking in Sydney, Melbourne, Brisbane, you're looking at anything between 5% to around about 6%. If you're going a little bit further afield, we can push that up to 6+%, so 6 to 7. If you're going regional into the smaller towns and cities, then you might get 7.5%. So loaded question, and there's lots to be answered in that. Again, reach out. I think it's best that we go through your portfolio, and I can help you in a discovery call to see how this would best work for you. Okay, I'm going to jump down to Matt. So Matt is asking, how do I explore new property investment opportunities without prior experience? Well, Matt, it depends what your portfolio looks like. So have you ever bought residential property? Let's start there. Do you have a principal place of residence, a home? Do you own your own home? Where do you start looking? Look, the obvious place, if you're just going out there and looking for properties, you'd be going to Real Commercial or commercialrealestate.com. Those are the 2 most common places to go find properties. So it's a very loose question, and this is where we would dial you back a little bit. And the first thing would be to identify what your budget is, what equity you have, and whether you'd qualify to buy a commercial property. So I hope that answers your question. And yeah, that just sets you on the right road. Again, reach out and let's see if we can help you out. It's a very simple step that we take you through. It's a basic process that we can take you on, which is answering a couple of questions. We talk, we go through it, we talk about what your background is, what your experience is, and take it from there. I got Thomas that's asking, what is the best way up? Yield versus interest rate in property investment. Well, Thomas, I kind of covered that a little bit earlier, but yield versus interest rate is a very interesting one because both of them are moving, all right? So your interest rates are at their highest at the moment. They're very, very high. Your yields is something that you need to have a look at over a period of time. So in other words, if you're buying a property right now that is yielding 6% and you're paying 6.6%, you need to be having a look at that property and looking at various different things. Number one, what is the value of the property at rebuild value? So in other words, if you're buying a property that is in very good condition, and let's say for argument's sake, you're buying it at $2,500 per square meter, and the average building of the same type of building is currently being built for $3,500 per square meter, well, guess what? You are buying that property at a discount. So you're buying it for $1,000 less than what it costs to build that property. What is that telling you? If there are new builds that are going in that area, their cost is more expensive, which means that their rentals are going to be a little bit more expensive as well. So based on your rental, if you're getting that property at a rental which is at current rental market or slightly lower than that, that gives you an opportunity to increase your rent, to add additional income, and to grow your property, to do rental approvals, rental reviews, maybe every 12 months, so that if your rental is at the lower end and there are new properties that have come in and they're at the higher end, you can catch up to those. And what that does is it grows on autopilot, incredible cash flow. So it just accumulates cash flow second to none. So it's a great opportunity if you're looking to grow your income, if you're looking to add value to your property. You can do that without lifting a finger. And that is the beauty of commercial real estate. It's one of the greatest things about commercial real estate. So what are you looking for over there? So you're looking for a property that is, I'm going to call it under rented. And how do you know if it's under rented? Well, you need to have a look at what else is going on around in the area. Preferably something that is sort of the same age or newish, that you know that you can attract the same types of tenants or good tenants, and you can beef your rental up. Also, a property that's maybe at the end of their lease, and again, it's very dependent on your risk profile, how you negotiate that with the tenant. You can negotiate the tenant back into the lease, maybe at market rate. So in other words, a little bit higher rental, which means that the minute you take that property on, you're achieving a higher rental, and inadvertently that means that you're achieving a higher valuation on that property. So again, hope that helps. And these are all opportunities to add value without lifting a finger. So these are little nuances that you get to learn. We work with you. We look at it from a case by case. How's that for dropping my words? We will work with you on a case by case study to have a look at those properties and see if there is potential to add value and where it is and how long it would take. Okay. So here we have the next question is from Grant, and Grant is asking, what is your suggestion for optimizing property investments in self-managed super fund, including commercial versus residential? Well, Grant, commercial versus residential, that's a huge consideration. So in residential, you got to realize that when you're buying residential, and your rentals, when you're looking at your rentals, generally they gross rentals, which means that you're paying the outgoings, that you're paying for the repairs, the maintenance, the insurance, that you're paying for a lot of the moving parts in that property. In commercial, your tenant invariably is paying for all of that. So this is the beauty about commercial, is 9 times out of 10 you've got net leases, which means that your net profit is coming directly to you, and the tenant pays for your rates, your taxes, the outgoings, security, maintenance, all the upkeep of the property. Sometimes they'll even pay land tax. Sometimes and 9 times out of 10 they'll even pay management fees. So you really want to get a lease. We'd love to have triple net leases where they pay for absolutely 100% everything. If not, then you need to have a look at what percentage of the outgoings they pay. You knock that off and what's left over is the net, which would determine your cash flow. So how would you optimize an investment in a self-managed super fund? Depending on where you are in your age, and I would suggest put as much as you possibly can in the self-managed super fund. I mentioned a little bit earlier that buying a self-managed super fund right now is a little bit expensive. It's tricky. But if you can wear it, then I would say do it. Because bearing in mind that when it comes to fruition, it's interest-free, no capital gains on it whatsoever. Lovely to have properties in those self-managed super funds, especially if you've got a property that you're adding value to. And you're asking, how do you optimize that property in a self-managed super fund? Depending on the property grant. I mean, is it an office property? Is it industrial? Is it retail? What can you do? So you're always looking at how you can add value. Who's your tenant? What is your tenant asking for? Can you increase your rental? Are you doing rental reviews? And by doing rental reviews, how this works is very interesting. Because if you're not doing rental reviews, what's happening is you're being left behind. And what's also happening is you're actually doing your tenant an injustice. Because if your tenant decides to move out, they would have to move into another area, probably a little bit further out, because they wouldn't be able to afford anything in that area as a presumption to the same quality. So you really want to be growing your rentals at that little bit of incremental increase so that the tenant is staying at market value and your property is staying at market value. Also, because your property is going to be valued at the rental that you are getting for that property. So you really want your property to be valued at market rate. There are a number of ways in a self-managed super fund, and there's also quite a lot of restrictions of what you can do with those properties. So long as you're not doing major renovations, you can be doing internal fit out or stripping down of properties as well. So, and when I say stripping down, I'm talking about, let's take, for instance, a property. Let's take a warehouse, for instance. We did one a couple of years ago where the warehouses, the tenants had built little offices, and they built the internals. They had a mezzanine, and then they built internal offices for their particular needs. So one was for storage, one was for maybe accounts, one was for filing, and you had all of these little sort of rabbit warrens of offices, and it was just clutter. So what we did is we got in there and we stripped them all out. So we took the property back to a blank canvas. What does that do? It gives a new tenant the opportunity to come in and see an absolute blank white canvas for them to create whatever they need, particularly for their business. So we had one tenant that came in and loved the space and turned the upstairs mezzanine into sort of a lounge room, sort of a relaxation kind of room. And then downstairs they were doing distribution, and on the far side they had an open plan office, and it looked really, really stunning. So it looked really great. And that was adding value, huge amount of value, because that rental was around about $50,000 after doing that. There was a negotiation in the rental of who paid for the fit out and that. And within 3 years, that property was around about $65,000 worth of rental. So that's where you get your value. And $65,000 of rental is a huge uplift. And I just want to give you an example. I'm going to do it at 6%. So if you are adding $15,000 to your rental, you're inadvertently adding $250,000 to the value of your property. So if you bought that property for $1 million and you're getting an additional rental of $15,000, you've now got a property that is worth $1,250,000. So you've added $250,000 to the value of that property with doing very, very little. Beautiful, don't you think? Yeah. Okay. Any questions? I got a question from Sue. Sue's asking, what is the minimal capital required for commercial real estate? Sue, I'm going to be saying that you're going to be cutting it fine at $200,000. So your minimum would be around about 200,000. At 200,000, you're going to be buying a property at around about 500,000. Your rental income at 500,000 is going to be in the region of about 30 odd thousand, probably slightly less, 25 to 30 odd thousand, depending on your yield. And that is a good place to start. However, very competitive, and generally you've got to look really, really hard to find a good quality asset at that price. You don't want to be buying off plan, and if you are buying brand new, make sure that you are running your numbers, checking your numbers, and make sure that you are buying that property at a decent market price. I've seen some of these new properties, the cheaper end of the market, where because they're smaller, there's generally a higher demand for them because more people can afford them. But you'd be paying in the region of about $5,000 or $6,000 per square meter. Is that worth it? You've got to weigh it up. Okay, so they are around, they are possible. You've got to run your numbers. You just be 100% sure that if you're buying something at that price, that you're paying the right price for it. Okay. So, guys, I hope this is giving you some information and helping you out with a couple of decisions. The whole purpose of doing these calls is interaction. The whole purpose of doing these lives is so that you can get live feedback on your questions, what you're looking for, and it's in real time. So send in your questions, click on the link below. That will take you to a question page where you can just write your questions in. I'm going to add it in, and we're going to run these every week. And I'd also like your feedback to find out whether this is a good time. Is this a good time to be doing these questions? Or please send me your suggestions and let me know what is a good time for you guys, because this is all about you. I'm doing this is purely educational, so I'm doing this 100% for you. And let me know if this is a good time for you to be joining me for a Q&A session, because that's what it's all about. This is education. I'm giving you information over here that hopefully will help you move forward on your property journey, on your investment journey. So Christine sent a question in, and her question is, what are the best types of commercial properties for first-time investors? Well, Christine, very difficult question to answer because it depends what your budget is. Okay, so very dependent on what your budget is. So I'm going to assume that your budget is a low budget, under $1 million. What are the best type of investments? Right now, the sweetheart of the country, everybody is wanting industrial properties. There's industrial. Everybody wants industrial properties because industrial properties is what is in short supply. We look at office properties right now. They're a dime a dozen. Nobody really wants them since COVID. And the only office, sort of successful offices besides the huge corporate offices, is shared office. And even that's, some of them are struggling a little bit, depending on who the operators are. So we're looking sub 1 million. We're looking at warehouses, industrial, and we are looking at retail. So there's quite a lot going on in the retail space. And you're wanting to be buying a property with as many exit strategies as possible. What do I mean by that? Let's have a look at a showroom type office. In these industrial complexes, you might find some properties that have got a showroom front with a roller shutter door in the back. Now, the advantages and why we love those is because there's so many different types of businesses that can be housed in those types of assets. And what I mean by that is you can have somebody who does pure distribution. You can have somebody who does a little bit of manufacturing and need office upstairs. You can have somebody who is pure office, where they're converting office upstairs and downstairs. We've seen ad agencies. We've seen digital agencies. You can have somebody who's doing soft sort of manufacturing, where they're manufacturing from the back and they put up a little office in the front. So the front showroom glass area becomes an office reception kind area, and then the whole back area would be manufacturing and distribution. So there's a multitude of types of assets that you can be doing and looking at right now, which are great properties for first-time investors. The other type of good properties for first-time investors is anything food-related, anything hospitality. Generally, you find that those hospitalities have spent a lot of money for their fit-out, and they usually have some skin in the game. So in other words, they would have spent a certain amount for those fit-outs, and they'd be pretty invested in their business. So those are pretty good properties, and those would be, you know, you can find those kind of properties at around about 400,000-500,000, and of course they go right up to over $1 million plus. So good little properties for first-time investors. Again, if you want to know more, reach out, go to revolvecommercial.com.au and find out get more information on that. So I hope that's helped, and I hope this is giving you guys a wealth of information. We still got a couple of questions to go through. The next question is from Jamie. And Jamie's asking, where are the best commercial real estate opportunities for investment in specific regions and types at the moment? Jamie, what a loaded question, mate. You said Adelaide Retail Warehouse. Well, I'm going to invite you, Jamie, to listen to the next podcast that we're about to bring out. I have done a podcast just today on the major infrastructure that's being spent in and around Australia in 2024. It will blow your hair back, all right? And the reason I'm saying that is because there are billions that are being spent in various different states. And we went through every single state. We went through Queensland, Victoria, New South Wales, Tasmania, Northern Territories, Western Australia, Canberra. And I have identified, with the help of the realestate.com bulletin that they published very recently, on the infrastructures that are going into those areas and where the infrastructure is going. So why is that important? Because wherever that infrastructure is going, they are anticipating people are going to be moving into. So that's going to be driving the residential development, and residential comes first, commercial comes after. So where you got resi, commercial follows. So it's a great indicator of what's happening where, and where you should be looking, and where you should be looking to buy. You're asking about Adelaide. There's a lot of infrastructure that's going in on the south side of Adelaide, I believe, freeways. And I was actually with Sam on a podcast this morning, and Sam was saying she's from Adelaide, and she said the roads there are horrendous. She said they're terrible. Well, I didn't have the same experience. I've traveled around Adelaide a little bit, and granted, I haven't been on those terrible roads down south, but there's a lot of infrastructure. There's a lot of money that they're going to be spending there, and I'm talking about millions and billions. We're talking about 250 million that they're going to be putting in, and they've got a rail line that's going down south as well, and that's in anticipation for population growth. We also this morning on this morning's podcast, and guys, go ahead, please click on the podcast. This podcast was only recorded this morning, so it's probably going to be published in about 2 weeks' time. It takes that long just to edit it and get it out. So look out for it, because it is absolute gold. It is gold. It will tell you exactly where you should be looking for future prospects. Okay. He's asking about retail and warehouse. I'm going to say yes and yes. Both of those assets in the southern part of Adelaide, if you're looking for that growth, that's exactly where you're going to be finding it. So Christine, no, sorry, I'm speaking to Jamie over here. So Jamie, I hope that answers your question. And yeah, look out for more information on that. Follow infrastructure, where the money's going, particularly government spending. So wherever government is spending money is where you're wanting to be looking to put your investments or buy your investments. Okay, Jamie, the next question is from Linda. And Linda is asking, what are the most reliable sources for property research and value add strategies? Data, due diligence, podcast, Facebook. So, Linda, we kind of spoke about this a little bit earlier, where you're asking for the most reliable sources. Look, as you know, when you're working with the buyer's agents, as a buyer's agent, we work on a lot of data. We accumulate a lot of data. We do a lot of research, and that data is dependent on the type of asset and where we're looking. Okay. I've launched a due diligence book. I would highly recommend, if you're going to be doing this by yourself, go onto the website, download that due diligence book. We're just about to launch version 2, which is an update of version 1. We've just made some minor tweaks. Due diligence is a massive, massive topic, and it's forever changing. So the difference between due diligence on doing residential property is like walking up two steps and opening the front door. Doing due diligence on commercial property is like walking up Mount Kilimanjaro, seriously, and looking for red flags. So your hunt is for red flags, because the agent's not going to tell you, and you've got to go looking, and it's the nuances. You've got to know what you're looking for. So we happily give out a heap of information. That due diligence book is packed with information, and there's lists, there's questions, all that kind of stuff that we'd be happy to share with you as well. Podcasts are a fantastic source of information if you like listening to stuff. There are heaps of good podcasts. The Revolve Commercial podcast, for instance, we're launching and posting stuff on a weekly basis. So jump into the podcasts and go and have a listen. And also Facebook groups. Now make sure that when you're doing the Facebook groups that they are Australian Facebook groups, because there are a lot of American Facebook groups. And they're a great source of information as well. There's a lot of lives like this. If you've got the time, make the time and get out there and do them. Okay, so good luck, and yeah, reach out if you want that, or just hop onto the website and you can download the due diligence list. We're also in the process of doing a legal booklet. Now, I'm not a licensed advisor, so I'm not going to be giving you advice or anything. It's just it's basically a guideline of the nuances of what you should be getting from your solicitor when you are engaging a solicitor. That's all it really is. Okay. Well worth having in your back pocket though. So, Linda, I hope that's answered your question. Okay. Our next question is from Adam, and Adam is asking, how do I go from residential to commercial property investments? Adam, beautiful question, mate. Okay, very simple. Like I mentioned before, buying residential properties is like taking 2 steps and getting to your front door. Buying commercial property is like climbing Mount Kilimanjaro, all right? Very, very, very different type of acquisition. You need help if you have no education whatsoever. Jump on, get educated. We offer courses. We've got an online course that is well worth doing. It's a very elementary course. We offer mentoring as well. If you're the kind of person that you want to get your hands dirty, then jump into the mentoring courses. Well worth it. This is actually a little part of mentoring, and this is the kind of assistance that you get. The biggest thing that you need to be getting ready is get market ready. So what do I mean by get market ready is Number one, we need to know, or you need to know, or your broker needs to know, how much equity do you have? All right, so how much cash do you have that you're going to be using to buy a commercial property? That would be question number one. Where's that cash coming from? So if it's currently tied up in investments or properties or portfolio, can you do a drawdown on it? And what is the value of it? And how much are you paying for it? So that would be organizing and setting a budget for you to see what your lending rate would be and to see what your budget of spend would be. So I'll give you a quick example. I'm going to make it very simple. Let's work on, let's say you have $350,000. Let's make it a round figure, $400,000, okay? And it's clean cash. It's sitting in the bank right now. It's earning conservatively 3.8%, 4%, okay? Now, if you take that 400,000 and you go out there and you buy property, you're going to be able to afford a property of $1 million. So your loan, your LVR, loan to vendor ratio, is going to be about 65%. Your expenses, depending on which state you're buying in, is going to be in the region of about, I'm going to say about 50,000, okay? 45 to 50,000. So that's your 400K. You're going to get a property that's worth $1 million. Let's say your property's yielding 6%, and you've put 400K that's been earning 4% conservatively in the bank. What does that mean? It means that now that 400,000 is paying you 6% back. So at 6% for $1 million, your rental income is 60,000. All right. Your 60,000 is now giving you a cash flow of around about 20 to 25,000 plus, depending on what your loan rate is. So there are a lot of numbers in the background. It's a very loose question. It's a great question that would require a little bit of drilling down on. And again, if you're interested and you want to go further, click on the button, go to Revolve Commercial and book a call. Happy to take you through it and run through some discovery with you. Okay. Our next question is from Anthony. And Anthony's asking, what do you suggest for lease management and outgoings to attract tenants in challenging markets? Anthony, bottom line here is incentives. Okay. So you want to throw as many incentives out there as possible. Number one, depending on where your property is, how long has it been vacant for? What does the property look like? And previously, earlier on in this chat, I mentioned that the best thing to do if you have a current property that is vacant right now, what condition is that property in? Because what you want to do is you want to strip that property out and you want to make it look as sexy as possible. Okay, there's only one way to say that. Make it look as sexy as possible and to attract a better tenant. So it's very much a matter of looking at the property and checking out what can you do to that property to make it better and take it to a blank canvas. Once you've got it there, have a look at what properties are going for, what are the rentals. Maybe go in at a slightly lower rental, but then put a lot of incentives in there. And when I say incentives, I'm talking about free rentals over a period of time. I'm talking about offering people fit out. So a fit out in the property. And sometimes I'm going to say, let's say a property's worth a round figure, $1 million. You might want to be doing a fit out for a business that wants to spend 200,000. Always make sure that they've got some skin in the game. Okay, so that they're actually putting their hand in their pocket as well. Otherwise, what's happening is the risk is that you're spending 200,000 and in 3 years' time, they're walking away. So you want them to have some skin in the game where they are maybe spending 100,000 and you're putting 100,000 in. But here's the best part. If you're putting 100,000 in, you can actually add that to your rental over a period of time. So you can actually add that over and above your rental for the next 2 years. Get your 100,000 back So they spend that inadvertently, which means that they're far more invested in that property and in that premise. So I hope that answers your question. With regards getting it ready, and agents, of course, speak to agents that are on the ground in the area, work with those agents, and never cut their commission, incentivize them rather. Okay, so that's a great question. A lot of people always asking about vacancies, and I'm happy to chat a little bit more about vacancies and how to mitigate risk with regards to that. Okay, next question is from Joseph. Joseph, what strategies do you use for finding off-market deals? Joseph, there are two strategies over here. Number one, you can go door knocking and speak to owners themselves. It's a very laborious process. If you have the time, happy days. Go and walk the streets and speak to people. That would be your best, your absolute best. And in residential, I know that's a very common practice. Or you could do letter drops where you're asking people, if they want a valuation in their property, if they're interested in selling, and very similar to residential. However, it's not really a done practice in commercial. I would say the best way to find off-market deals would be to be networking with real estate agents who have the know, who have their feet on the ground, and they know whose leases are coming up for renewals. They know which tenants are about to move out. They know which tenants are looking for properties and wanting to move in. So really, really, I would say strategy number one, network with as many agents as possible. They're not going to hand you those properties on a silver platter, because you've got to remember that they've got a plethora of clients that are hunting for properties right now, and off-market properties. There are a lot of do's and don'ts. There are a lot of red flags with regards off-market properties, because often you find that if you're buying an off-market property, the seller is not prepared. He hasn't prepared the property for the sale. So the requirements that you're going to be needing, they perhaps don't have at their fingertips. Some of them are a little bit slack with their paperwork and that, and it could take you a little bit of time. So it's a great question, and most definitely a topic for a podcast. There we go. I'll come back to it. So thank you for asking, Joseph. We're going to move on to Kerry's question. Kerry's question is, what are the initial steps for starting in property investment? Kerry, I've kind of covered off on this, but the initial steps would be, if you've never bought property before, always recommend that you buy residential first. Why? Because residential is easy. Okay, residential is the easiest type of property you can buy. Never buy off plan. Don't ever buy from marketers, because you got to realize that if you're buying from marketers, you're paying 3% more or 30% more, and you're paying for their marketing fees up front, which means that it's going to take you probably about 5 years to recover that before the market catches up with it, so that you can start profiting on the property. So always buy a property that is an established property if you can. If you're a first-time home buyer, that's something slightly different. Be very circumspect about running your numbers and making sure that you're buying at market rate. Don't compare it to other new properties in the area. Rather compare it to slightly aged properties, and you do a percentage ratio on that. I can't tell you what the percentage ratio is until I actually have a look at the property. So if you've got residential properties and you want to move into commercial properties, fantastic move. It's the great thing to do, because in residential you reach a ceiling. In commercial you never reach a ceiling. You continue going depending on the type of assets that you're buying. So the first thing you want to do is that budget. Have a look at your equity, what your equity is going to buy you. So if you've got 400,000, your equity is going to buy you $1 million worth of property. That's sort of round figures. Okay. Kerry, go to Revolve Commercial, click on a couple of links there, and you'll get a lot of answers. Have a look at our past webinars that we've done as well. Some very inspiring stories in there that might get you thinking. Okay. Miranda, Our next question is from Miranda. So Miranda's asking, how do you negotiate no money down deals? Great question, Miranda. This is loaded. There are so many strategies to doing no money down deals. You can do vendor finance. You can do delayed settlements. You can do off-market sale before you take occupation. There's a multitude of no money down deals. You can get joint ventures. So if you know what you're doing, get a joint venture partner to come in. We're actually going to be doing a podcast on this very shortly, and we'll go through about 11 or 12 strategies of how you can do this, and they range various different types of no money down deals. So stay tuned, check it out, and yeah, we'll probably be doing a podcast on this in the next month or two. Okay, but that's pretty much, those are the general ones. A delayed settlement. You can do options as well. If you get lucky, you can do an option. And it's not really about doing the no money down deal. It's about the nuance of what does the seller want? You know, is the seller ready? How negotiable is the seller? And what can you give the seller? So it's not about you. This has got nothing to do with you. It's not about you trying to do a deal that is a no money down deal. This is all about the seller. What does the seller want? So you find maybe they're running a business and they really want to go touring around the country. They want to resign. They want to retire, and they just want to get their money out, but their money is tied up in another business, and it's going to take them 6 months or something. So what you can do is you offer them a little bit more, and you ask them for that time. So do a deal with them, and that would be an option where you're optioning the property at a slightly higher price. So if they're asking for 3 million, you maybe give them 3,100,000, and that means that there's no rental for that period. They still carry on earning the rental out of that, but in the meantime you could be working on the property. So that is a negotiation. It's a hefty topic, and there's quite a lot that goes into that. Great question though. Incidentally, no money down deals in commercial, quite difficult, especially in a hot market at the moment, because you've got a lot of buyers and you've got sellers that if they put their property on the market, they want to sell, they want their money now. So they're not prepared to give you that extended time. Also, if you're buying property through an agent, you've got to take that into consideration, and how is that agent going to be paid for that deal. So you need to do a negotiation with the agent and with the seller at the same time. Okay, so it's a bit of a tricky one, that. But they can be done, like I say, with skillful negotiation. Okay, Rudy has sent me a question. Can I pay for commercial real estate out of other entities? Well, Rudy, yes, you can, most certainly. And depending on how you run this, so can you pay for commercial real estate out of other entities? Yeah, absolutely. It's called loan accounts. So you can loan from one to the other. So I'm assuming that you already have properties and that they've got cash in them, and you'd want to be purchasing a property. All you'd be doing is doing a loan account from property A to purchase a property B. Okay? So it really is a matter of bookkeeping and accounting, where and always keep it pretty clean so it's easy for your accountant to track back where that money's come from. So let's say, for argument's sake, you're buying a property of $1 million and you own a property of $3 million, and you've got a whack of cash in there. You've got 400,000. I'm using 400,000 again just because it makes the number quite a lot easier. And you loan that 400,000 to the new property that you're buying for $1 million, and what you'd effectively be doing is paying that loan back over a period of time, or your accountant can do a book loan. So in other words, it's a paper transaction. So I hope that answers your question. It's a very common thing, and the more properties you purchase, you'll find the more loan accounts that you're going to have in between your entities, or you should have between your entities. Also bearing in mind that there's profits and there's losses. So depending on the number of entities that you have, you always want to declare the losses first so that you can offset them up against your profits. Again, I'm not an accountant. I can't give you advice. Speak to your accountant about this, but it's very, very doable. So I hope that helps. Guys, that brings us to the end. We do have a couple other questions. However, they're very, very long-winded questions, and I'll do them separately, or perhaps I'll do them next week. And I just want to say thank you if you have jumped on. Thank you for joining me, and thank you for your questions and sending them through. And I look forward to catching up with you next week. Till later. Cheers.